Virgin Voyages presents With Love from Alaska.
The scenery out here is unreal. Mountains, glaciers, waterfalls. The ship? Designed for panoramic views, which is why I'm pretending to be a wildlife photographer. I am not. Yesterday we were hiking and kayaking. Today, I'm watching for humpback whales. Anyway, wish you were here.
Award-winning, kid-free Alaskan cruises from Virgin Voyages with immersive shore excursions and zero kid energy. VirginVoyages.com.
Hey, this is U.S. Olympic gold medalist Tara Davis-Woodhull.
And I'm U.S. Paralympic gold medalist Hunter Woodhull.
As athletes, our lives are about having a clear path.
And a team that you can absolutely trust.
So when it came to getting the best mortgage,
we chose PennyMac.
PennyMac is proud to be the official mortgage provider of Team USA and you.
Learn more at pennymac.com. PennyMac Loan Services, LLC, Equal Housing Lender, NMLS ID 35953. Licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act. Conditions and restrictions may apply.
There's a fire inside you can't ignore. Stand still? Not a chance. You're a lifelong learner who's come this far. Now, we're here to help you keep going further. Capella University. What can't you do? Visit capella.edu to learn more.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into the processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Today, my co-host is Breanne Dougherty, head of thematic strategy at Bloomberg Intelligence. Bree, thank you for joining me today.
Always a pleasure, David. One of my favorite places to be.
So, in a recent note, you wrote that U.S. exceptionalism still matters, but it's no longer the whole story. As we've seen concentration risk reemerge with the tech sell-off and AI back at the center of debate, how should investors be thinking about where the next phase of AI leadership actually comes from?
Yeah, I think that the last year has been a really telling one. And what we've been saying is we think 2025 set the signals. And then in 2026, we're going to see some broadening of that opportunity. So again, we're not at all saying that U.S. exceptionalism is dead. The U.S. naturally has an extremely important role to be playing in what we see happening in AI. The hyperscalers, first and foremost, specifically as we look at this, CapEx-driven cycle that we're entering into or just starting to enter into. But what we really want to highlight is that I would say the DeepSeek of January 2025, so think back a year ago, was a bit of an eye-opener that this isn't a one-horse race, right? And that this is very much a global AI continuum that we're all on. And we think that we're going to see more and more investors. We've seen it in the back half of 2025. We continue to expect that this will continue to take hold in 2026, that investors are looking globally. Right? They understand the opportunity of the United States, but they also understand that you're going to see a lot of great innovation coming out of Asia, coming out of Europe, and that a really good way to look at the portfolio is to make sure that you have a balanced exposure there. The other thing that we're highlighting is naturally, we tend to be lovers of equal weight. I'm particularly a lover of equal weight in 2026. And just highlighting again that especially as we look to themes such as AI, but also across all of our innovation themes, we think that sometimes investors can get really hung up on the most well-known names, right? And that's typically those big mega caps. And there tends to be a lot of U.S. tech tunnel vision when people think of innovation. And we actually see a lot of opportunity in lesser-known names. And that's one of the work that Thematics, I think, really brings to the forefront is just how much opportunity is sitting outside benchmarks. And we really expect the broadening to continue through 2026.
Great. And so we all know AI is definitely considered a mega theme. And it just so happens today we have a mega theme portfolio manager as our guest today. So I'd like to welcome Sarbjit Nahal to the podcast. Sarj is a portfolio manager and analyst with the Global Thematic Equity team at Lazard Asset Management. Sarj, thank you for joining us today.
Thank you for having me. It's a pleasure to be here this morning.
So we're going to be discussing the Lazard Equity Megatrends ETF, ticker THMZ. Can you walk us through the core investment philosophy behind the fund and what megatrend investing means in practice?
Perfect. Happy to say a few words. And, the core philosophy behind themes is rooted in the belief that we're living in an era of unprecedented transformation and disruption, whether it be structural shifts in terms of demographics with aging populations, geopolitics with the emergence of a multipolar world, or in terms of technology and AI diffusion. And if I were to quote 18-time All-Star and 13-time World Series champion Yogi Berra, the future ain't what it used to be. And investors need to prepare their clients for a future that is no longer predictable, no longer stable, or no longer a simple extension of the past. And these transformative and disruptive forces are no longer peripheral trends, but they've become central drivers of everything from dispersion to volatility to disruption and ultimately long-term value creation. And we can see this with the lifespan of companies in the S&P 500, which has fallen from 60 years in the 1950s to 30 years in the 1980s to an estimated 12 to 15 years by 2030, the end of this decade. And the growth in so-called Kodak moments of companies who are simply failing to foresee and adapt to the pace of disruptive transformation. And we really see megatrends investing as offering an invaluable North Star for investors looking to adapt for the future and navigate these structural shifts. And in practice, this means leveraging a bottoms-up, fundamental research and valuation discipline-focused approach when it comes to investment. And we believe this offers clients two things. Firstly, it's an opportunity to invest in high-quality growing companies benefiting from structural change at a reasonable price, what we'll refer to as themes or megatrends as a reasonable price along the lines of CARP. But secondly, longer-term optionality from 10 to 20-year themes that are currently on the investment frontier but rapidly becoming reality. So things like autonomous vehicles, humanoid robots, quantum computing, SMRs, as well as space.
So, if we take a step back, how do you define and identify these mega trends? Is there certain criteria that your team uses to decide if a trend is structural enough to be included in the fund's investment universe?
Yeah, of course. As our starting point, we really see megatrends as long-term, large-scale global structural shifts with the potential to reshape global industry economics and profit pools. And we also believe that the evaluation and selection of megatrends requires robust fundamental grounding. It needs to be validated by both company-level insights as well as Lazard's global research platform. A forward-looking approach is critical to timing theme selection, as you generally don't want to be buying when the theme has reached page one of the newspapers or is all across your social media, or for that matter, your parents or your grandparents are asking you about it. You want to be focused on the ideas that are on section C, page 32 of the newspapers, but slowly moving their way towards page one. And our investment edge in this regard lies in the 4,500 company meetings that we, together with our fundamental analyst colleagues, have with companies every single years. These meetings account for about 50% of our time as PMs and allow us to build a picture of our transforming world. And during these meetings, we ask the CEOs and senior management strategic questions about things like structural changes over the next 3 to 10 years, the evolution of both demand and supply, CapEx investments which are being underestimated or ignored by the market, and future sources of revenues and profit pools. And in essence, these collected data points allow us to both identify emerging megatrends and to focus on idiosyncratic stock factors, while also tying our megatrends to 3 to 5 year valuations for companies. And practically speaking, each megatrend must also be able to offer durability, scale, and investability across a diversified set of companies. And at present, we run a concentrated portfolio of 60 names across 6 themes or megatrends. So that includes smart CapEx, smarter industry, and a new era for capital investment, bits of chips, key selective components capturing value from digitalization, empowered consumer, the winners in a whole new world of consumerism, software agents, the next major evolution of software, data and AI, competitive advantage from applied AI, and then finally future health, which is focused on solutions to the societal challenges in and around healthcare.
Can you describe how your proprietary multi-theme process works in terms of how themes evolve over time in the portfolio?
Yeah, of course. Well, as thematic investors, we anchor our portfolio to multiple themes or megatrends rather than benchmarks, which we believe don't tell you very much about the future and lead to a framing bias. And As a Canadian, I'll make an ice hockey analogy. We need to be skating to where the puck is going, not where it currently is. Now, as mentioned, we have 6 themes in our strategy, with our belief being that, firstly, each theme captures a different subset of structural factors. Secondly, that different themes pay off at different times and in different ways. And that, thirdly, themes evolve over time. We also believe that a multi-thematic approach reduces risk and smooths return patterns over time. In essence, it affects competition for capital between themes, as opposed to a single theme approach where no one tells you when to evolve or sell. And obviously, we run an active ETF, and our themes are dynamic and evolve off the back of our bottoms up research and the data points we're collecting from our meetings with companies. And as evidence, as economics, as competitive dynamics, as policy directions change, new themes emerge and existing themes can shrink, expand, or be retired based on our conviction. But to put things in perspective, we are true long-term investors. The average lifespan of our themes averages about 5 years, and portfolio turnover is about 20% per year.
So I'm glad you mentioned bottom-up research because that was kind of the next part I wanted to talk about. Is there a specific approach to selecting, once you have your themes, to selecting the specific companies, certain fundamental metrics you like to use, or even, any biases towards geographic regions or even market caps?
Yeah, perfect. Well, in terms of investment process, we've got a robust and long-standing four-step process. Firstly, we're looking for thematic fit, with companies needing to clearly benefit from the structural drivers behind a theme. And it's important to stress we're not looking at simplistic quant or revenue exposure screens and stock lists, but rather at the evolution of business models, exposure to exogenous factors, and how stocks will benefit from the return opportunity over time. Secondly, we're looking at stock-specific factors. The reality is that no stock will ever be a perfect fit for a theme, and there are many idiosyncratic factors at play, from the quality of management to worrisome legacy businesses to sustainability concerns. And these are often swept under the carpet by top-down investors, but we choose to go deeper, working closely with Lazard's fundamental research team and their insights. Thirdly is valuation, where we place an overarching focus on year 3, so 2029, and year 5, 2031, and on whether the valuation is reasonable, whether there's a possibility of upside if the theme plays out, and ultimately on capturing asymmetries. And then fourth and finally is diversification. We have multiple themes and multiple stocks per theme, and layers of diversification across market segments, geographies, products, services, as well as sectors. It's very much our belief that diversification allows us to access different return profiles. And generally speaking, we equally weight themes and stocks, and we regularly take profits and recycle them into strong structural stories experiencing moments of weakness.
So I do have a follow-up to that. You touched upon valuations. Are there specific valuation metrics you consider, or does it kind of differ from stock to stock?
Yeah, happy to say a word there. And firstly, I would just stress that, so much of the focus in terms of thematic and megatrends is on narrative-heavy areas. And it's important to stress there's certainly some great narratives or stories associated around megatrends, but we really pride ourselves on our valuation discipline. Our emphasis again is on that bottoms up, long-term valuation, years 3 and years 5 in particular, but also the thematic optionality playing out over longer periods, so 5 to 10 years. And it's our belief that these are timeframes where markets tend to be less efficient and structural change is generally underappreciated. But in terms of valuation, rather than fixing targets, our team, we work extremely closely with Lazard's 70 fundamental analysts to compare what the market is discounting via consensus and price with what our differentiated long-term judgments say. Valuation approaches can be flexible by company type. We're recognizing everything from annuity-like elements through to optionality. We're leveraging scenario-based analysis, which helps us to calibrate materiality and avoid overpaying for popular or narrative-driven themes. And our valuation discipline also means that we can help our clients access the best themes and the best companies of tomorrow early and at a reasonable price, because themes at a reasonable price, mega trends at a reasonable price is half the heart of everything that we are trying to do.
Is there any type of top-down research as part of the process? Do you kind of incorporate any type of macroeconomic or geopolitical insights into your framework?
Yeah, of course. And, as you can imagine, macro geopolitical insights are critical for us as a megatrends team, especially in light of the new realities of the fragmented, the transactional, the intensely competitive, multipolar world that we're living in. And we really see these inputs as key to shaping long-term foundations and construction of our themes, as opposed to those who would use them for tactical positioning or short-term timing. So just to give you an example, we see strategic investment in U.S. manufacturing and industry as accelerating due to macro and geopolitical challenges. We see the scales tilting away from chasing low-cost labor back towards domestic production. And we believe capital and proximity to the end user is going to dictate the national and regional allocation of CapEx, parameters to which the U.S. has no equal. We also see the U.S. is in the very early innings of a massive reindustrialization wave, which could become a multi-decade opportunity, which we size at a minimum of $10 trillion in the coming years. And as the U.S. aims to regain the 20 to 25% of global manufacturing share that it commanded in the 90s, we see an increasing focus on reshoring high-value strategic supply chains and critical infrastructure. And in terms of examples, semis or chips, that industry is clearly becoming one of the biggest focus areas. And if you take a look at 2025, as of July, semi companies had announced over $500 billion of private sector investments across 28 states to revitalize the U.S. leading edge chip ecosystem and move towards this whole idea of sovereign AI. And U.S. pharma manufacturing is another reshoring beneficiary with $370 billion of investments in 2025. So we're looking at the macro, we're looking at the geopolitical, but we're trying to see what sort of bottom-up impacts that is having in terms of our portfolio.
So I know Bree has some really great questions digging deeper into the themes themselves, but I just have one more question on investment process
Please.
before we move on. You work alongside a few different co-managers on this strategy. How does collaboration work in terms of theme selection, sizing, and portfolio reviews?
Of course. Well, just in terms of the team itself, Lazard's Thematic and Megatrends team comprises 6 members, 4 PMs, a portfolio analyst, and a client portfolio manager. We're based in both New York and London, and we are one of the world's most experienced thematic teams with an average of 24 years of industry experience, including an average of 11 years at Lazard. We have complementary backgrounds that span the buy and sell side, geographies, areas of study and interest, and one member was actually a former member of a national chess team. But it's important to stress that beyond the core team is that we're collaborating throughout the day with an emphasis on cognitive diversity and collective decision-making, with everything from theme and stock selection, sizing decisions, and portfolio reviews made jointly by the PMs, supported by ongoing debate and shared research ownership. But it's critical to stress the importance of the interconnected insights that we derive from the investment network at Lazard. We have access to and regularly leverage a world-class network of 70 sector specialists across continents who help us to construct our bottoms-up vision of the world. And we're an incredibly interconnected platform. We're in constant touch with the fundamental analysts, with dedicated chat groups with each of them, as well as a firm-wide big picture weekly global thematic meeting, which has been running at the firm for well over two decades now.
A lot of what you were saying there echoes with also, the law approach we take. And you said some of my favorite words: asymmetric,
Great to hear.
right? Idiosyncratic. All those really good ones when you start talking about thematic. I was looking at the current membership and interested to hear your perspective, thinking back to the question I answered of David at the very beginning here, when we think about going global versus focusing on opportunity potentially being unlocked in the U.S. You've got a decently high weighting to U.S. Interested to hear on if there are certain of the megatrends that you're focused on where you are looking more global versus other ones that you're more focused on being US driven.
Yep, yep. Perfect. Happy to say a word there. And I think I would take things one step back. And what I would really stress is it's our view that investors need to look beyond the horizon
Mhm.
to capture tomorrow's alpha and future wealth. And basically, this requires a fourfold shift in investing wavelength. And the first is just clearly moving from short term to long term. All of the market volatility that we're seeing on a daily basis presents opportunities for long term investors. But secondly, exactly in line with what you're saying, we believe that we need to move away from the US to becoming more global. Global allocation can help us navigate a shifting market performance in what really is a new regime. And thirdly, we need to diversify from that sometimes obsessive focus on data centers and AIs to more diversity across sectors, market segments, as well as companies. And then finally, as we've discussed, we need to shift away from those backward looking benchmarks to being forward looking. Now, if you take a look at the portfolio itself, what you end up with is a portfolio which truly is global, right? About 63% North America and 37% rest of world. And this reflects global profit pool distribution and where many leaders in structural change reside. So I was talking about the changes that we're seeing, for instance, in the manufacturing and renaissance space in the United States. Massive opportunity, but this is a space where we need to look towards some of the European as well as the Japanese actors as we look to instill everything from automation, digitalization, software, and AI-based operating systems for factories through to industrial robots, as well as the emergence of humanoid robots. But if you look at the portfolio, the way that we think and the way that we act, it also results in a portfolio which is very well diversified. We've got about 40% technology, but we have material exposure to healthcare, to industrials, to financials, as well as consumer companies. And our global approach, as well as our equal weighting based philosophy, basically means underexposure to mega caps, even when based in the US, providing broad participation across global trends.
I think that's really interesting, and you mentioned in there, specifically as it comes to AI, let's be honest, can't help almost every conversation I have with clients, even when we go in with a different topic of conversation, I feel like we always come back to AI. I think it's interesting what you said there, looking beyond AI, looking beyond the data centers, and I know you mentioned also this really, keen focus that your team has on the 3 to 5 year, right? And where the opportunity is gonna sit there. Naturally, though, we've got this volatility and this tension. Great opportunities to lean in when you get some of this volatility. Where in the AI ecosystem or which aspects of AI are you watching most closely right now, understanding that you're prioritizing where things are gonna be in the 3 to 5 year window?
Yeah, happy to share some insights there. And I think firstly, it's there's no getting away from the fact that AI has and will continue to dominate the investment landscape. We're anticipating about $3 to $4 trillion in AI infrastructure spend by the end of this decade. And what companies are telling us is that they likely need to double compute every 6 months, which obviously means a 300 to 1,000 time increase over the next 4 to 5 years as they strive towards AGI or artificial general intelligence. And if we want to put things in perspective, it's really most comparable to the 19th century railway boom, with both of these representing massive, transformative, and potentially speculative investment cycles. And to put things in perspective, Gilded Age railroad investment peaked at about 6% of GDP. But if we look at AI hyperscaler CapEx alone, in 2025, it was about 2% of GDP. And obviously, it's been increasing by the day. And a lot of people will always ask us, why are we engaging in one of the costliest building sprees in human history? You take a look at the last 3 years of AI spend, and it's greater than what it cost to build the US interstate highway network over 40 years. Why are we seeing multi-billion-dollar AI factories bigger than 10 Home Depots being built in windswept towns like Ellendale, North Dakota, which has 1,100 people, two motels, $1 General, and a Pentecostal Bible college? The reality is that AI compute demand continues to exceed supply. It's the fastest growing technology in history, faster than the TVs, the internet, smartphones, or previous computing revolutions. You look at the consumer space, ChatGPT achieved 100 million users in 2 months. It is now close to 900 million. That's a record for a consumer app. We now have 70 to 88% of businesses and 99% of the Fortune 500 who are actively deploying or exploring deploying Gen AI. That compares to only 10% 2 years ago. And 75% of companies say that they're now completing tasks that they were never able to do before. And the reality is, this is unlikely to change anytime soon, given that we're only 3 to 4 years into what is likely a 25-year investment super cycle, and that the street has consistently underestimated the capex in this space. But that said, if we bring this to an investment and a portfolio in terms of perspectives, the long-term opportunity is really going to be rooted in sentiment on ROI and return on investment, and that balance that exists between AI capabilities, long-term incremental revenues, and productivity and efficiency upside. And obviously, we're seeing growing revenue opportunities. If you look at what's happening in terms of the cloud with enterprise adoption of AI workloads, what's happening in terms of digital advertising with improved targeting, and AI subscriptions, so people paying for tools and agentic services. These three areas alone represent $1 trillion of incremental revenues over the next few years, with AI-driven OPEX and CAPEX efficiencies further pushing up company operating profit margins. But what we are really excited about is that shift from data center build-out toward broader implementation and applications. So this includes AI agents across industries, AI at the edge, for example, with smart glasses and new form factors, and physical AI in spaces like autonomous vehicles and humanoid robots, with up to $50 trillion of industry set to become autonomous. And from a macro perspective, if we go back to the macro, what I would stress is that AI could contribute up to 14% of global GDP by 2030. And to put this in perspective, we're talking about $15.7 trillion worth of GDP as AI enables automation, products, decision-making, scale across sectors. And this is key. They boost global productivity after 20 years of stagnation or decline. We're talking about 900 billion plus in benefits for the S&P 500. And this translates into about $16 trillion in potential long-term market value creation potential. And what companies are telling us quarter after quarter, the reporting is improving in this regard. They're telling us about the profound productivity shifts that are coming from AI. Improving the efficiency of coding by 80%, AI speeding up drug development by 8 to 12 times, AI accounting for 75% of claims adjustment and underwriting in the insurance sector, all the way through to total cost of ownership savings versus humans of up to 85% in the manufacturing sector. So massive opportunities beyond the data center. Also some areas for caution, which I'm happy to get into if that might be of interest.
Well, I think what is really refreshing to hear is naturally over the last 18 months in particular, it's been so focused, and I don't mean to say that it shouldn't be. We know that these bottlenecks are very much what need to be solved for the next 3 years. It's where the CapEx is having to be allocated, is the upstream bottlenecks and that real infrastructure component of enabling AI. It is a little bit refreshing, actually, to have a bit of a conversation that sometimes has been very much put on the back burner because you're not necessarily seeing it in the stock performance about those downstreams. So like if, upstream AI versus downstream AI, it really has been a bit of the forgotten spot, I would say, over the last 18 months. If anything, maybe getting hit a little bit harder versus all that focus on the upstream. And it is refreshing. Just a hard thing to have the conversations about is patience is a virtue in this type of situation, right?
Totally.
And I do think that's something, especially as you say that you guys are so focused on 3 to 5 years, is that's where you're going to start to really see those downstream acceleration of the work that got put in now and it actually paying off into some of those downstream applications and their growth there. That being said, I did notice now a couple things. One, I'm also Canadian. Really appreciated the puck reference. 2,
My pleasure.
I will always take one of those. 2, I did notice that in your megatrends breakdown, you also flagged something else that I'm deeply passionate about, power.
Mhm.
And power being back on the agenda. I think those are the words that were maybe in, I don't know, something I'd seen come across from your team.
Sure.
Let's talk. One of the things that I find so interesting about power is it's almost like every single time I have to enter the conversation saying, guys, debottlenecking power and improving the power grid has been a priority for a decade now, more than a decade now. AI just, we already had a problem. We already needed investment. AI has just now quadrupled, the situation and brought it mainstream and brought a whole new set of eyes to the situation, which I think is really, really compelling. I often break this down between two things: grid tech or
Mhm.
centralized power versus I'm loving seeing actually the increased focus, particularly from the tech investors, towards decentralized power. So I'm interested to hear your take on how your team is addressing this power being back on the agenda, and how you're working that into your current ethos.
Yeah, perfect. Happy to share some thoughts there. We're in total agreement with you, and if you take a look at the U.S., if you look at many developed markets, we're seeing power demand is increasing after 2 decades of relative stagnation. It's being driven by the growth in AI and data centers, as well as industrial activity from reshoring, and then increasing electrification across industry sectors and across end markets. And just to put things in perspective, if we look at US data centers alone, monthly and annual capacity additions reached record monthly highs of 1.4 gigawatts in December, record annual highs in the US of 10 gigawatts in 2025. Now, this matters because a 1 gigawatt data center consumes the equivalent electricity of 750 to 800,000 homes. Data centers have boosted U.S. power demand growth to the highest level in 20 years, leading to more than half of regional power markets reaching critical tightness last year. And if we look forward, we're in total agreement with you, data centers could be consuming 12% of total electricity in the U.S. Now, against this backdrop, we really see investment opportunities as being driven by four key dynamics. The firstly is going to be a focus on low-cost energy to support rapid
Mhm.
AI infrastructure growth and reshoring of industrial capabilities. This is going to include natural gas. It's also going to include decentralized power. Secondly, there needs to be an increasing focus on innovative technologies. We've seen a lot of excitement and take up with regards to nuclear and particular SMRs, but also with regards to things like carbon capture, batteries, and energy storage. Thirdly, we're probably looking at a situation of global energy deflation as the U.S. exports cheap natural gas to key global markets. And then finally, and this is an area where we need to engage in a certain degree of caution. We think that the political dynamics are going to become increasingly important. There's a heightened focus on energy bill impacts for consumers and voters, and this is one of the biggest areas of stakeholder backlash to AI. We saw $100 billion worth of data center projects being canceled last year. We saw close to 30 states passing regulation in
Mhm.
this regard. So definitely something that needs to be on our agenda.
Yeah, and I think it's a good thing to flag is NIMBY's ever obviously not new to the energy industry. I do think it's newer to the tech industry. They've never really had to navigate that type of dynamic. But you're right. It is the stakeholder management and stakeholder engagement that goes alongside this type of build cycle is not to be underestimated and not to best to assume it's not going to be linear and smooth sailing, right? I feel like
Exactly.
we learned those lessons, or we should have learned those lessons, the
Well,
early 2000s.
also one of the advantages of a global, diversified,
Mhm.
multi-thematic approach at the end of the day.
Absolutely, right? And every region's gonna have it, and naturally, as you said, this is a global build out, right? You can't just be building out every nation has
Exactly.
prioritized it on their national security prioritization from an AI perspective. As you mentioned earlier, space is also getting recognized for that as well,
That's right.
really dovetailing with the national defense recapitalization. So I think that's also a really beautiful intersection is that it's obviously been prioritized in the US, but we're seeing it prioritized through APAC and also through Europe, everybody not wanting to be left behind. I think this is maybe a tricky question, and to be honest, I don't know how I would answer, which is probably why I'm asking, because 'cause I'd love
Fire
to
away.
have an answer.
I'll give it my best.
When you think about what you guys are looking at right now or how you're positioned, and where you see the opportunity, is there something that could happen in the next 12 months that would pivot you aggressively? You mentioned something like a 20% average churn. Is there, we'll use the term black swan. Is there this potential black swan that low probability, but if it happens, you would absolutely be looking to make a more dynamic shift within your current structuring?
I I wouldn't say there's one black swan, and to be quite honest, it isn't great for our sleep patterns, but we're in a constant process of addressing developments that could challenge our thematic priorities.
Mhm.
We're looking at everything from shifts in global policy direction in a multipolar world, slowing economic activity that could impact capex, competitive intensity or technological disruption, and then valuation compression if expectations run ahead of fundamentals. And if I try to bring that in perspective of some of the shorter term things that we've been seeing in the market, as you can probably imagine, a lot of recent emphasis has been on the impact of AI on software companies.
Mhm.
And this is an area where we've been shifting our focus away from slowing SaaS growth over the course of the last few years towards a variety of new drivers. So we're placing an increasing emphasis on outcomes rather than seats, on
Mhm.
tapping into booming AI budgets. These continue to increase while overall IT budgets are flat or stagnating. The rethinking of interfaces and the monetization of AI agents on top of systems of record. And from a valuation perspective, we're also looking at valuations which have sometimes fallen into their low teens. But in light of free cash flow multiples, which are even better than that, and with net cash balance sheets. But ultimately, we consider ourselves experts on structural change. That is our bread and butter. And what we're obsessively focused on is many of the emerging challenges that are ignored by shorter term investors. Just to give you a flavor, we're seeing significant negative shifts in public sentiment on AI. One of the major surveys is on 2025 is that 50% of Americans are now more concerned than excited about AI. We're looking at the macro impacts. AI is currently able to automate 25% of all working hours. What is this going to mean in terms of the need for reskilling and upskilling? And then we're looking at things like electricity and power, which we talked about, 100 regulations in 30 states. Passed in the US in 2025 alone. And we're now talking about things like wholesale electricity auctions to fund long-term contracts for new power generation capacity. All of these things are potentially on the horizon, and obviously could impact the composition of
Mhm.
the underlying portfolio.
I mean, I don't know if you guys saw it, but the Chris Hemsworth Super Bowl ad yesterday, fear of AI, right? It is true. More people, great ad. One other, and maybe this will be my final question, and I'll
Please.
leave it to David. The thing that I think 2025 was most under the radar takeaway for thematic investing, from my perspective, was I think we're seeing institutional investors finally understand this is where you are to be front-footed, right? Just the drag and the lag that you're inherently exposed to with some of the more traditional constructs. I think we saw it specifically track a lot of the global thematic ETF flows naturally, and we were seeing just based off the behavior, it was a record year for thematic ETF inflow through 2025, really strong start to 2026 as well. Interestingly, where we saw the biggest allocations were going to these big, like, heavy structural demand type areas: AI, defense, infrastructure, nuclear. Um, I'd love to hear your opinion on the fact that we have hopefully hit that inflection point in thematic investing where once upon a time it was purely thought to be a retail investor type of focus, and the potential for us to be gaining some real traction amongst institutional investors.
Sure. I'm in total agreement with you in that regard. And if anything, we would argue that thematics and megatrends are increasingly relevant for all investors,
Mhm.
retail as well as institutional. I talked about that Yogi Berra quote that the future ain't what it used to be. But it's very much our view that, thematics and megatrends are increasingly key to capturing alpha from the combination of investing in high quality growth companies benefiting from structural change but at a reasonable price, as well as longer term thematic optionality. So the alpha story is key here, but the relevance for investors goes well beyond this. It really lies at the heart of investors' ability to retain and grow their books of business. And as you alluded to, investors need to follow the money, follow the dollars. Thematic assets reached a 3-year high last year of $779 billion globally. And this is no longer a European phenomenon. The U.S. has been seeing the fastest growth worldwide. U.S. AUM has grown 50% over the last 3 years, helped again by the rise of active ETFs. But secondly, we need to pay attention to the changing demographics. 40% of American millennials and 40% of American Gen Z, or Gen Z as we would say in Canada, investors, so those aged 30 to 45 and 14 to 29 respectively, already use thematic megatrends investment. And then finally, we're in the midst of the largest ever generational wealth transfer in human history. We're looking at $124 trillion, which is set to shift to younger generations in the U.S. alone by 2048. But in an extremely worrying sign, only 13% of investors retain their parents' or grandparents' FA, their financial advisor, when the money passes hands. I talked about those Kodak moments earlier, but the reality is that younger investors think and act differently than previous cohorts. And ultimately, what this comes down to is that the logic and the expectations of a yesteryear are becoming obsolete in a transforming world. And megatrends investing is going to be critical to reduce the looming risk of disintermediation. So in a nutshell, what we continue to do, what we've always done, is to urge investors, whether they're institutional or retail, as well as their end clients, to look beyond the horizon, to focus on the long term, to go global, to diversify across opportunities, to be forward-looking, and ultimately to capture future wealth for multiple generations to come. And at the end of the day, that's what we're trying to do with Lazard Equity Megatrends, or themes.
Well, that's a great way to end it. This was a fantastic discussion. Sarge, thank you again for joining us.
The pleasure was mine. Thank you for having me.
And Bree, as always, thank you for being my co-host.
I never say no, David. Always one of my favorites. And this was a particularly engaging conversation. So thank you so much.
This was good. I also want to thank our listeners. If you liked the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research, and BITHEM Go for thematic research. Until our next episode, this is David Cohne with Inside Active.
Virgin Voyages presents With Love from Alaska.
The scenery out here is unreal. Mountains, glaciers, waterfalls. The ship? Designed for panoramic views, which is why I'm pretending to be a wildlife photographer. I am not. Yesterday we were hiking and kayaking. Today, I'm watching for humpback whales. Anyway, wish you were here.
Award-winning, kid-free Alaskan cruises from Virgin Voyages with immersive shore excursions and zero kid energy. VirginVoyages.com.
How do you want to spend your day? At Brightview Senior Living Communities, you decide, and we'll take care of the rest. Pamper yourself at the salon and pursue your creative passions. Toast with your friends at happy hour and savor chef-prepared meals. Close out the day with a concert just down the hall from your apartment. Or simply relax. The choice is yours. Enjoy the comforts of home and the security of award-winning care. Discover the possibilities at brightviewseniorliving.com.
Well, the holidays have come and gone once again, but if you've forgotten to get that special someone in your life a gift, well, Mint Mobile is extending their holiday offer of half off unlimited wireless. So here's the idea. You get it now, you call it an early present for next year. What do you have to lose? Give it a try at mintmobile.com/switch.
Limited time 50% off regular price for new customers. Upfront payment required. $45 for 3 month, $90 for 6 month, or $180 for 12 month plan. Taxes and fees extra. Speeds may slow after 50 gigabytes per month when network is busy. See terms.